Keynesian thinking came to life after the Great Depression. All the classicals who have been around for centuries, they believe that the government shouldn't get involved in the economy. They have very good reasons to believe that. They say that the government, as soon as it gets involved in the economy, first of all, the government won't be as efficient as the private sector. Second of all, the government will then reward certain special groups at the expense of others. So it will create some sort of discrimination in the economy. Therefore, just don't touch it. Just stay back, Mr. Government or Mrs. Government. Let the market come back, uh, as you can see in this here. Let the market reach a trough and then come back again. The economic activity will be normalized. In 1930s, after the Great Depression, we started to realize that the costs of not doing something could be great. Like we're talking about the Second World War, many economists, many economists believe that the Second World War was a result of the Great Depression. What happened in Germany and all the Central Europe, these guys, they just couldn't fix it. They kept going down, they kept going down, they kept getting worse and worse and worse. And people started to be hungry. And when people are hungry, they tend to listen to some really weird ideas, follow some really weird political movements, and there you have it. You have a war, you have destruction, you have every bad thing on your hand. While the classicals were still waiting for the markets to clear and we have a trough and then an equilibrium. Keynesians, they said you need to go get your hands dirty, you need to start fixing things. Keynesian model gave birth to the New Deal in United States in 1930, when everybody was unemployed. And like people had to stand in lines just to get free food. People were actually starving. So the government started this huge projects to build roads, to build train tracks, to build bridges all over the country. And of course, up to this day, still many classicals are saying, like, look at that bridge shouldn't have been there. That bridge is the result of the government being friend with some politician, with some senator, and then making certain deals. So you see, that's discrimination. That shouldn't have been there. But still, it kept the economy going. It made the economy go back on track. So yeah, this is the main difference in thinking. This time we talked about different variables. How can we sense a recession happening, and how different variables respond to a recession. Leading variables are variables that happen before the recession. Laggings, they happen after, and coincident variables happen simultaneously at the same time. We also talked about how stock market prices are pro-cyclical and almost I don't remember exactly, was it like lagging, or was it the leading or coincident? They happen very close to a recession and they move in the same direction of the economic activity. So the basic idea, the classic understanding we had prior to COVID crisis was that when there is a recession, the stock prices will fall. And this was proved in 2008. Wall Street crashed. Everybody was like, oh my God, we have a huge recession on our hands. So pro-cyclical, moving in the same direction as the economic output, economic activity trend curve. If it's going up, it goes up, and if it goes down, it will go down. Counter-cyclical, or variables that would behave opposite, like unemployment. When economic activity goes up, unemployment goes down. People will have more jobs. So these are the two different types of responses, and we will be last time. Yes. You can see here, real GDP, it's basically a proxy for economic activity. You can see, in 2008, when there is a recession, real GDP growth rate falls significantly. This is 1930s. See, not this one here. This is after World War II. When World War II ended, because the government was spending a ton of like unimaginable amounts of money on the economy, because there was a huge war that needed to be funded. After the war, many Keynesians, they predicted an economic disaster, and it was for like 1 year really bad. As you can see, GDP went down really sharp because the government was no longer spending all that money on ships and building planes and all those, like soldiers being paid, sailors and airmen being paid, and they had to come home, and there was no longer jobs for them in the government, in the military. But then after that, the economy started to go up. And you can see 1950, period of relative growth and stability. Before that, 1930, this was the problem. You see, start of the 1930, it keeps going down. This is what caused Keynes to gain attention. Nobody took him seriously before. It was like he's just a shy communist. Many were saying that John Maynard Keynes is just a communist who is too shy to say he's a communist. So he wants to get the government involved in the economy, therefore he's a communist. But then when things started to get worse and worse and worse every year, people started to listen to Keynes. Okay, maybe he has something to say. And this is the New Deal. You see, New Deal turned things around. Even though it has a lot of problems, even up to this day, United States is still kind of influenced by the New Deal in 1930s, but still it saved the country. You can see that economic activity turned around. Go ahead, Prem.
What about all the other, like, this is kind of the argument that I hear from everybody who's not a neo-Keynesian or I guess a regular old Keynesian, is that, like, basically, or at least the monetarists will say that the monetarists will say basically that, like, the reason why the New Deal was so bad, or not the New Deal, the Great Depression was so bad, is because of the money supply. The currency was actually deflated, and that's why they needed to, like, instead of trying to do all these kind of new programs and stuff, which didn't really help. And that's actually why the Great Depression lasted so long. It lasted for 10 years. The reason why it lasted so long is because they just didn't fix the money supply and stuff. And like, that's why you have, I think that it was a flash crash of, not the flash crash. It was like it was like a quick recession in like I guess it seems like 08, where you see like that just quick like dive and then goes back up.
You mean the 2008 Great Recession?
No, not 2008. That one was a pretty long lasting one.
The .NET bubble, 1990s.
No. It's I think it was like 1908 recession, something like that.
Here, yeah. I understand what you're talking about. There was a problem with inflation. I don't remember exactly what was like. Yep.
Yeah. The financial panic in 1907. But pretty much like because you had Calvin Coolidge. Calvin Coolidge was president then. It was like a really quick one because the government didn't get involved. Whereas the Great Depression lasted 10 years because government was spending all these kind of things. They were forcing rationing and stuff, which I mean, the rationing I can understand because of the war, but basically like consumption was limited and they didn't increase the money supply. So like the people just didn't want to spend.
Sorry, I didn't hear the last.
Oh, I was just gonna say people didn't want to spend because the currency was deflated. That's what monetarists would say is the reason why. Like that's what Milton Friedman said, is why the Great Depression lasted so long.
Yeah, but Milton Friedman was a classical, so you must like understand that he's the one who brought back the whole classical thinking.
Well, yeah, he brought back monetarism, or not? Didn't I guess he invented monetarism, right? He didn't really bring it back. He invented, or did he bring it back? I don't know if he kind of invented it or not.
Yeah. Okay. Let's leave Milton Friedman alone. He's like a god in economics. I'm pretty sure in our department there is a hidden shrine somewhere. Like you need to take a book or something, and then a hidden door will open, and there is a shrine dedicated to Milton Friedman, and our professors will go there and pray. he's very important. Yeah, I tend to make that jokes about him.
Well, the next joke you can make after that is that what's it called? Paul Krugman is basically the next. I heard this argument made that Paul Krugman is actually like the modern day Milton Friedman, which you get many of those people riled up because they both have Nobel prizes. They're both public intellectuals, and yeah,
I can't say that because I actually wrote like I was part of a team that wrote a paper, and we criticized Paul Krugman's new trade theory very heavily. I'm not a huge fan of his thinking. His thinking is when it comes to at least international trade, which is my research. I worked on this one. His thinking is flawed. But Milton Friedman, he's a rocket star in economics. He's different. Okay, let's move on. Now, you can see unemployment. It's counter-cyclical. 1930s, Great Depression, goes up a lot. Well, economic activity fell. And inflation, you can see that it is pro-cyclical. When a recession happens, people won't spend so much money. So money will be like saved. They would keep their money saved, and they would not spend that much money. That's the money supply thing that Prem said. Money supply would go down, and then inflation would go down. Of course, there is a special case which is called an inflation recession. It's basically like it's a recession with inflation. It's when there is so much the drop in economic activity, and the government tries to fund its own finances. For example, in Venezuela, the government had all these ambitious free stuff programs, free here, free there, everything is free. And then when the recession started, the government had to pay for those. So the government started to print money, money supply went up, inflation went up, and economic activity at the same time went down. So that's also a case. But in most 99% of situations, when we're talking about responsible governments, at least, inflation and economic activity, they move in the same direction. Now, time horizons in macroeconomics, study of business cycles, they focus on short-run economic fluctuations. John Maynard Keynes, he questions the classical view that the economy moved quickly to their long-run equilibrium. I can't talk today. Equilibrium, seeing that in the long run, we're all dead. Keynes argued that the primary focus of macroeconomists should be on the short run. You have to fix the problem now, not to just get paid by the government and tell everybody not to do anything and wait and wait and wait. So the followers of Keynes or Keynesians also argue that the government should pursue active policies to stabilize economic fluctuations. So the government needs to get involved. This is the main difference between Keynesian thinking and the classical thinking, or also it's also called the Austrian thinking or Hayekian thinking after Friedrich Hayek, the philosopher, economist. Huge man. If you're interested in this debate, you should Google F.A. Hayek or Friedrich Hayek. There is also a very funny video I will share with my students. It's about the differences between the two. I will post that later. Now, before we continue, I want you to watch this that we talked about yesterday. I watched this again and I realized that it is worthy of class time. So this loads. Remember, we said that stock market prices are pro-cyclical with economic activity. So they move in the same direction. When there is a recession, stock prices would crash. COVID changed this. Let's see why. Can you hear the video?
Not yet, at least.
Yep.
I can't hear it. No.
No, you can't hear it. Let me. What now? What about now?
No, I don't think so.
Okay, yep. I think when I share my screen, you won't be able to hear it. So let me do something. Open the Moodle page, everyone.
I think there's like a setting on the bottom of your thing where you can like share screen and then share screen audio.
Advanced sharing, 1% network only. I just have the share screen. Share sound. Yep. Thank you. Share sound.
Earlier this year.
You know, we've had these furious rallies.
Investors continue to put their money into our stock market.
You're seeing new record highs on the S&P and NASDAQ.
Major indexes haven't just recovered from the coronavirus shock.
Can you hear it?
They're on a historic.
Yeah, we can hear it.
Great. So thank you very much.
But while
We've had these furious rallies.
Investors can.
stock market is back up after falling off a cliff earlier this year.
You know, we've had these furious rallies.
Investors continue to put their money into our stock market.
You're seeing new record highs on the S&P and NASDAQ.
Major indexes haven't just recovered from the coronavirus shock, they're on a historic winning streak. But while stocks climbed, millions lost their jobs and fell out of the labor force. Companies say more layoffs could come this fall. This means that the wealthiest Americans are netting huge returns, while the poorest are losing opportunities to make money.
I think the question on everyone's mind has been, how is the economy so bad while the stock market is soaring higher and higher?
So you see, this is the shock here. For the first time, we witness something strange. Now stock prices are not necessarily pro-cyclical with the economic activity trend.
To get a sense for the disconnect, you can look at the labor market.
We still have 11 million people out of the 22 million who were laid off in the payroll numbers in March and April. Still 11 million out there, and that's really good progress. We've put fully half of those back to work, but that's a long way to go.
Our economy had come to a standstill during the pandemic. Americans are getting laid off. They're making less money. They're spending less money, and all of that hurts our economy.
About half of the workers in the leisure and hospitality industry lost their jobs this summer. Casinos.
Remember, unemployment is counter-cyclical to economic activity. So unemployment rose sharply, therefore we have a recession. But at the same time, stock prices, they're not behaving themselves.
Airports and music venues sat virtually empty. That's weighing on consumer spending. It plummeted in March and still hasn't reached pre-pandemic levels. Experts say that this is unlikely to change until the virus is contained. That means businesses are making fewer sales and hiring fewer people. There were 10.7 million fewer US jobs in September versus February. That will make it more difficult for the unemployed to find work. Despite a crumbling economy, the stock market has soared, and there are a few forces driving that rally. Most notable were the policies coming out of America's central bank.
We acted forcefully to get our markets working again, and as a result, market conditions have generally improved.
In March,
you see, this is the first difference. Before 2008, the government and the Federal Reserve, which is the monetary or financial arm of the government, depends on how you look at it, wasn't experienced in dealing with these situations. Now the Federal Reserve was experienced. They were ready to go. They were prepared and they intervened immediately. Of course, very important, remember that the Federal Reserve intervened but didn't create jobs. Unemployment still went down, but it helped the stock prices go up. This is one of the reasons that Keynesians are being criticized. Only a certain people in the economy benefited from all the funds of all those spendings of the Federal Reserve, which was directed at helping the stock market go up.
The Fed made emergency loans available to banks, local governments, and other players in the global economy. That kept investors optimistic about the future, and that can drive up the markets.
Investors said the Fed stepped in like they'd never had before. Their response was quicker and more muscular than ever before, and that was a key driver for the stock market this spring.
The bank started by slashing interest rates to near zero, which made it cheaper to borrow money.
When interest rate is almost zero, that's basically free money. So if you're expecting even 1% profit, if you're expecting to sell anything, just anything, and you're expecting to be able to make just the 1%, you will take the loan. Like an epsilon, even less than 1%, a poor fraction of a percent. As long as you're making a bigger profit than the interest you have to pay for your loan, you'll walk away with a profit, a net profit. This is called the net profit. After you paid off your obligations, whatever remains for you will be your net profits.
Then the bank started to buy debt. By September, the Fed controlled $7 trillion worth of assets, up from $4 trillion at the beginning of the pandemic.
Over coming months.
Now, Remember from our first chapter, we talked about first few chapters, we talked about free market operations. What happens when government buys bonds or increases its assets? What happens? What do we call it?
If government purchases go up, then
Not government purchases in a like a GDP sense. Government purchase of bonds. This is we're talking about money here. We're talking about paper money. Government purchases are like military budget, education, healthcare, bureaucratic.
okay, so you mean like more like mortgages or stuff like that, right?
No, bonds.
They increase the
Bonds.
supply.
Basically, the money supply would go up.
Yeah. A bond is just a piece of paper. A piece of paper which says the person who holds this is entitled to receive $1 million from the US government. The US government would then pay $1 million in cash, in paper money, to the person who holds the bond. Can I have that back, please, now? And takes the bond back. What happens is that money supply will go up because the person who just had a piece of paper now has $1 million on his hand. So money supply goes up. This
Would that make it a good time for investment?
investment in what? Like we're talking about.
What is it? Is there a correlation between investment and money supply?
That's a very hard question to answer.
You have inflation if money supply is too high.
Yeah, because like when money supply goes up, inflation will be created. You see, inflation can also be described as the average, the mean of all profits made across all industries. So when inflation goes up, on average, industries can be said that they're making more profits. But will your industry be the one that makes the more profits? Or will you be the one that is not making enough profits to counter the interest rates? Because when inflation goes up, also interest rate will eventually go up. And if you're not making as much profits, for example, interest rate is 10%, you need to be able to make 10% profits on average. If not, if you make 5% profits, you'll be losing money. So interest rate, inflation, it's, again, I have this example. Inflation is like how fast you're going above the speed limit on the highway. Yes, it is like, it's fun, it's good, but it's also very risky, very risky. So inflation also introduces some uncertainty and risk. So to answer your question, it's both yes and no. Inflation with regard to profits in a business, in investing on a business. That depends on how much inflation we're talking about. Like if it's 8%, that's different than 5%. If it's 30%, you're right, you're going very fast. Yeah, like it's too risky. That could also make you stop investing. It would cause a lot of problems, inflation. Prem, go ahead. You have your hand risen.
Yeah, I was kind of asking maybe a clarity question, which is, so whenever the government is buying bonds, they're basically injecting cash into the economy.
Yes, by paying off some of their own debts. So they're not printing money. They're not creating money out of nothing. They already owned that. They already borrowed that money, and they're paying it back.
So then is the money just coming out of, where is the money coming from if they're not printing it?
It's under like accounting. It's
So
like
it'd just be like Fed assets, like reserve?
it's a very good question.
Because I know before they had gold, and so if you wanted to, I guess, put more money out there, you just basically remove gold from the Fed Reserve.
Yeah, you got me. I've never thought about this before. Yeah, I'll have to get back to you about this tomorrow.
Because then it'd be the same as
Got me.
it'd be the
I've
same
never
as
thought
QE,
of
right? If they were printing money, then it would be the same as QE. That's what they were doing like before. I think a couple months ago they were doing quantitative easing to basically try and like buy back some of the debts and increase the money supply in the economy to try and get things going. And I guess like the big fear right now is basically, are people gonna like they want to try and increase consumption and velocity of money?
Yeah.
So like they hope people don't really hold on to the money. But like, yeah, I was just wondering like, where's the money coming from? Because if they're operating on a deficit, it seems like, and there's no reserve, because they removed the reserve after Bretton Woods.
Yeah, I have to do some research about this. Where does the money come from now? Like, I honestly don't know. I never thought about. Like, I've been reading about that this time the government is printing money, but I tend to not believe it at face value because these stuff are also very political, and depending on which channel you watch. Like, if you're watching Fox News, completely different than watching CNN. So I can't give you like a final answer now. I've heard that the government is printing money, and I also heard some other explanations, but I don't have like a final answer. Go ahead, Parker.
What do you think about disinflation in the economy? Would that benefit the economy, or?
You mean the like negative inflation?
Not negative, but like lowering inflation.
Lowering inflation would stabilize the economy. Lowering inflation would actually, it's let me tell you something. When in advanced macro courses, you have this, we're going to see it later, Phillips curve. It's called the Phillips curve. This is the objective of a central bank. The objective, the final aim of a central bank is to minimize inflation. So by minimizing inflation is always good. Keeping inflation low, it's always good. But what's the problem here is how much costs you have to suffer to minimize inflation. You see, inflation itself, it's not a good thing, but the road to get to inflation, that's the problem. So lowering inflation, it's always good, but it's not free. You have to pay a cost for that. Inflict certain cost on the economy, and you have to analyze whether the benefits are bigger or not. So a cost-benefit analysis here.
Is inflation kind of like grease if you think about it? Like if you put WD-40, if you put WD-40 on like some kind of engine, you don't want it to be like too slippery, but you also don't want it to be like there's no 40 at all.
When it comes to inflation, you almost always want it to be as minimum as possible.
Oh, really? Okay.
Yeah, but the problem is to make it minimum, you will also end up hurting the economy by messing with the money supply. So it's a very delicate thing. I still I kind of forgot about Phillips curve. We're going to see it at the end of this course. The operations of a central bank. This is like my first year PhD. We have studied this. And that's the objective of a central bank is to minimize the inflation. But at what cost? There will be a cost associated with minimizing the inflation rate.
We will continue to increase our holdings of Treasury securities and agency mortgage-backed securities at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions.
The bank's purchasing has sent yields on traditionally safe government debt to near all-time lows. That's driving investors toward stocks.
Treasuries all of a sudden don't look as attractive because the yield on them is so low. So if you want returns, you might as well go to stocks. And that's kind of the calculus that a lot of investors have been doing. And it's actually, people call it the quote unquote Tina effect. There is no alternative to stocks because yields are just so low. Where else are you going to go for returns?
This and
see another action that the government, the Federal Reserve has taken here by messing with the yields on one market, they drove all the investors towards the stock market. Remember, we talked about opportunity costs in EC 302. If you're an investor, the opportunity cost of your investment would be the profits that you will be making from your next best investment. When the stock markets are kept equally attractive, but then the other markets, the bond markets and all the other markets, because of the actions of the Federal Reserve, now will have historically low yields and returns. What happens is that suddenly your opportunity cost of staying in this bond market would go up and up and up until you're pushed towards the stock market. So the Federal Reserve here, again, pushed investors towards the stock market.
And other actions from the Fed propped up the markets, and the money that flowed from these policies went into one section of the market in particular, technology. Tech stocks lifted entire market indexes this year. You can see that by comparing the tech-heavy NASDAQ and S&P indices to the performance of the Dow Jones Industrial Average.
It's easy to think like, wow, stocks are doing so well. But what we've seen this year is that it's really a handful of stocks that are doing really well. And those are mainly technology companies.
Apple, Microsoft, Amazon, Facebook, Alphabet. These big names offer products that were crucial to live life and conduct business in the pandemic. And their leaders took note on earnings calls this summer.
This was a strong quarter for us, especially compared to what we expected at the start.
We began to see a significant increase in customer demand beginning in early March.
In an uncertain environment, Apple saw a quarter of historic results.
Investors expect solid earnings from these companies, which will boost demand for their stock.
You really can't overstate how well these tech companies have done this year and what a big role that plays in driving the S&P 500 up higher. Apple alone recently was worth more than all of the stocks in the FTSE 100 index or all of the companies in the Russell 2000 index of small stocks.
Tech stocks are doing so well that their gains are outweighing losses in financial companies and energy stocks, which haven't been able to rally. Smaller businesses are hurting too. Bill Ackman of Pershing Square Holdings said that if there were a stock market index of private small businesses, it would likely be down 50% or more. While investors lock in expectations for earnings in tech, a flood of action from individual investors is also changing the markets.
You're seeing newbie investors who had never traded before. They were stuck at home during the pandemic and they opened up brokerage accounts because it's never been easier to trade. It's never been easier to open an account.
Digital brokers like Robinhood offer commission-free trading, which has drawn more investors into the market. During the first 6 months of the year, individual investors made up about 20% of market activity. That's about a 5 percentage point jump from last year. Analysts said smaller investors drove up stocks like Nikola and Eastman Kodak, but they don't impact bigger names like Apple and Tesla. Brokers are making markets more accessible, but that's not helping the bottom half of American workers. Workers from lower income households were more likely to lose their jobs in the pandemic, and many in this group have historically been shut out of the stock market. Most stocks are held by the top 10% of Americans by wealth, according to data from the Federal Reserve. Charts like this sum up why a booming stock market seems disconnected from the economic reality for many Americans.
Very important here. You see, by adopting a Keynesian approach to the COVID crisis, the governments, not only in the United States, all over the world, they ended up helping certain groups win and lots of others lose. Now, you may say that these big companies are like super big, but in fact, the US economy is mainly made up of small businesses. So the majority lost here, but a minority won. And this is what classicals are always accusing the Keynesian of, that you're only making your buddies rich and everyone else will pay for it. That's like a very important point. Of course, the alternative would be that the government would do nothing and everybody would be very, very poor. So that's how like a Keynesian would probably respond. By making my buddies rich, at least I can save the economy from collapsing altogether. So stop sharing my voice. Yeah, share sound. Thank you for teaching me that. Great, let's continue. In the long run, prices of goods and services, as well as price of labor, which is your salary, wages, are completely flexible. In the long run, they respond immediately to changes in supply and demand. And this is what classicals are always saying. They're saying that, okay, there is a recession, unemployment would go up, supply of labor would be bigger than demand for labor, then workers would negotiate a lower salary. This lower salary, they would go back to work. This lower salary would then reduce the costs of companies. So companies will make more profits would go back into the company as investment, would make the company demand more workers. So demand for labor would go up. So workers would now ask for higher wages. And then you'll have the old situation. So the market would clear and there you go. You have your long run equilibrium. Keynesians rightfully say that this long run thing, it will not happen in like years. So the costs would be huge. And of course, if you have like a like a realistic thinking here, you can understand that one of the greatest points of the Keynesian thinking is that these people who are being hurt, they can also be considered as like economic firms. So if I lose my job, for example, I won't have money to invest. Invest on what? My children's education. So my children will not get an education. If the government waits and waits like 5 years, 10 years for the market to clear, my child is not going to remain 5 years old. In 10 years, my child will be 15 years old. And I can't wait for 10 years so that like the market clears again and I'll be getting paid. I cannot send my 15-year-old to kindergarten. The 15-year-old should be in a high school. And this is what Keynesians like emphasize, and they're right here. You see the Federal Reserve, they entered super quick. Of course, there are lobbyists and politicians who want to favor their own friends and their campaign donors. But what was the alternative if they didn't do anything? People would have been devastated. Lots of families would have been devastated. People who don't have work, they won't be able to pay for their children. Now, in a classical thinking, the children would remain children until the long run, until the market clears and everything would go back to normal. But in the real world, it's the short run that matters, because the child, the 5-year-old who needs to be invested on for his or her education will be 15-year-old by the time that this recession is over. Do you understand what I'm talking about? Am I making sense here? So, in the long run, prices are very flexible. This is what classicals are saying. The flexible price framework results in the classical thinking, in which there is a total separation between the real and nominal variables. Keynesian models focus on the short run, because Keynesians believe that prices are sticky. Prices respond slowly to changes in supply and demand. These two different thinking comes from two different view of the market structure. The Austrians or the classicals, they believe perfect competition. They believe that the prices are not sticky. They immediately are fixed. Classical models commonly assume perfect competition in markets where buyers and sellers are numerous. Therefore, when you have a numerous number, like an unlimited and infinite number of buyers and sellers, none of them can influence the market. They don't have power to influence the market. You don't have giants like Amazon or Google or Apple that can easily influence the markets. Keynesian focus on the importance of market monopoly power. Keynesians believe that companies have market power, and they can influence and they will influence the market. This is why, as we see more and more these multinational corporations, more and more people are asking the governments to get involved. The Keynesian thinking is now becoming more and more attractive. The classical thinking came back in the 1980s after all those huge corporations, they failed. All those there was like a huge mining strike in Great Britain. The mining companies, which were like super big, they failed and they were replaced by small businesses. The whole idea of a small business economy, which is actually what Margaret Thatcher defined the free market capitalism. Free market capitalism is based on the small businesses, moms and pops shops. That's the classical thinking. It works when you have small businesses, moms and pops shops. But not when there is a Google or there is an Apple. Those guys are big, they're strong, they cannot only influence the prices in their own markets, they can also influence the government itself. If Google wants, they can influence a few countries, I'm pretty sure. So in this case, you have a different situation. You have a monopolistic competition, as firms have the ability to set prices. Now, sources of price stickiness, menu costs. One thing that also Keynesians point is that wages and prices of the market, this is one of the reasons that they say Great Depression kept going on and on and on, is that these prices that we talk about in an equilibrium, supply goes up, price goes up, these are not happening every day. They may happen every few years. So changing prices involves many hidden costs. Collecting information is costly, so firms and households may engage in rational inattention. What does rational inattention mean? It means that basically I don't have enough money to collect new information about the market. Therefore, my best option as a rational person is to just stick with the old prices, even though I will be losing profits, but because I don't have any money to spend, or the money that I will be spending on collecting information will be bigger than the profits I'm expecting, I'll just won't do it. I'll just work with the old prices. By only making decisions about prices at infrequent intervals, every 2 years, for example. Many housing contracts. For example, if my apartment has a contract for like 2 years, and I want to renegotiate the contract, I would have to spend money on, let's say, commission for the real estate agents. And that commission is a cost. If that commission is too high, then I won't do it. Changing prices frequently may alienate customers, also from a business perspective. If you constantly increase your prices, you will lose your customers, because customers, they feel they are being mistreated. That's a business standpoint. Customers always love to think that they walked away with a really good deal. It makes us feel smart. When you buy something really cheap, like 50% off, you will feel good about yourself. Even if that thing, that 50% off, was twice as expensive as it should have been. So if a business person, if a salesman makes the price of something double and then give you a 50% off, you will be happy. You will feel smart. I will feel like I walked away with a really good deal. This would help your customers be attracted to your business. If you constantly change your prices, though, they will be alienated. Staggered price settings, it happens when competitors adjust prices at different intervals. This is also very important. If you change your prices on every odd day, and your competitor across the street changes prices every even day, the whole market, there will be no equilibrium. The staggered prices slow down price adjustment. Empirical evidence indicates substantial price stickiness in markets. Example, Alan Blinders found that only 10% of firms change their prices as often as once a week, and close to 40% change prices once a year, and 10% even less than that. That's huge. So basically, you can see that this long run equilibrium, it's actually very long run. It's not happening in real time. Prices, as we talked about in analyzing supply and demand, prices don't change real time immediately after one curve shifts. They take time, they're sticky. So this was the introduction in the business cycle model. For the remaining parts of this semester, we're going to stick to this model, and we're going to talk about aggregate supply, aggregate demand, and also the government's involvement in business cycle by trying to minimize the inflation and Phillips curve. And this will be our plan for the next month. So this part of our course, which was chapter 6, 7, 8, was your introduction to macroeconomic models, and you'll be responsible for this for your second midterm. And for your final exam, you'll be responsible for whatever is left, aggregate supply, aggregate demand. And if we have time for more, we're going to talk about government monetary policy and Phillips curve. And also I will let you know about 2 or 3 chapters which we covered so far, which are very important chapters, and I want you to re-study them for your final exam so that you got the most out of your money. Okay, any questions? If there is no questions, we have a lot of time left. Yeah. If you have any questions, you can ask now. If not, that's enough for today. And tomorrow we'll start chapter 9, and I will make your homeworks ready. Sorry, I've been very busy with my research and other things. I should have had it ready by now. I will make your homeworks ready, and